Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA, and today we're going to look at Carnival Cruise and Royal Caribbean Corporation. Now you know that in the recent market, both stocks have been absolutely hammered. The corona virus is causing the world to stay at home, and it's hammering all the travel and leisure stocks. Rental car companies, airline companies, hotel chains, casinos, and not to mention the cruise ship industry. Recently heard that I think it was Delta released an update that their revenue is down 90% for the month as people have just blatantly put their travel plans on hold. Here at this channel, we approach investing for looking for 5 key metrics, and we're going to take those metrics and we're going to apply them to the cruise industry. Now, I'm getting a lot of questions from fans or investors, and they're asking, what's the difference here between a reduced stock price and a good value? And what we're going to try to do is separate the two, look at the price decline, and say, what are you getting for this new lower price? I get the rationale is that if the stock was fairly priced 3 months ago and now it's down to 80%, isn't that a better buy? Don't you have assets there that if it goes bankrupt, there's assets to cover you, the business will return to normal, so on and so forth, therefore it's a good investment. We're going to check that and see if that's true. There are a couple things that we want to remember. One, nobody knows the future. So we don't know what next month is going to look like or what next year is going to look like. And two, if you do assume that over a 10-year period of time the cruise industry does return, there's no telling what vendor they choose to go to do business with, whether a customer chooses Royal Caribbean or Carnival Cruise. We don't know who's going to get the dollar. And two, the company has to be around 10 years from now to be in the position to get that customer. So if you're assuming that they're going to rebound, you have to make sure they have enough cash, they don't have too much debt, so that they can wade through this what is probably a temporary reprieve, and then emerge on the outside. They need the cash to do that. If they don't, then they're most likely going to go out of business, or there will be massive dilution to the equity holders. That would be you and I if we bought in today. So we're going to look at both Carnival and Royal Caribbean. We're going to look at it from our 5 attributes that we look for. That's revenue growth, earnings growth, positive free cash flow growth, a strong balance sheet, and it's got to be well priced. And we're going to do this, and we're going to look at them side by side rather than going through the 10K like we normally do and picking it apart. I'm assuming you've already done that and you've already read it. And then we're just going to dive into the analysis and look at them side by side to see which one of the two is the better, and then what do we think the industry is going to do in the future, and how can we look at an investment from that perspective. All right, here we go. This is Royal Caribbean, fiscal year ending December 31st. They've got 10 years here. This is the EBITDA calculation that we go through. Here's Carnival Cruise, same thing, 10 years of EBITDA. Now remember, EBITDA is earnings before interest, tax, and depreciation and amortization. That is a proxy for cash flow. This is a very capital-intensive business, cruise ships, and that EBITDA doesn't count the cost of the cruise ship. So we're going to look at EBITDA, and we're going to look at cash flow, and we're going to look at both of these to see how they stack up. So first off, let's check out our first 2 criteria, top line revenue growth and earnings growth. So we're going to look at revenue for Royal Caribbean, 2011, 2019, earnings have grown. Revenue has grown. Check. Carnival Cruise, revenue, 15 to 20, you have revenue growth there as well, although not nearly as, actually a little bit bigger here than here. They went from $7.5 billion to kind of 11 billion, 15 or so billion to 20 billion. So modest growth, really nothing that's skyrocketing, but it's present. If we skip forward, let's see if I can do this with each sheet and keep it all together for you. There's the EBITDA, you can see it in one screen. So we're going to skip through. Earnings before tax is what we pick up on the balance sheet, also called operating income. And that's excluding a lot of the below the line, as they call it, expenses or income. I'm just looking at operating profit before interest, before taxes, and I'm adding back depreciation and amortization to get to the EBITDA. For the Royal Caribbean, there were a couple impairments that I've added back, and I get an EBITDA number. Again, EBITDA has grown roughly double since the beginning of the period to the end of the period. For Carnival, can you see? Yeah, here we go. So 3.77 billion versus 5.4 billion. So both companies have grown revenue and have grown earnings over the 10-year period. Two check boxes for us, and that's a good thing. Let's continue moving forward and get to enterprise value, and we're going to look at their debt load. So here's enterprise value. I can only show you so much at a time, so I apologize. We're going to have to do this step by step. And I'm going to try to get through this in a reasonable amount of time so the video's not too long. But picking up EBITDA growth, you can see this is Royal Caribbean, 10% EBITDA growth over this period of time. Royal Caribbean's debt load went from 8.5 billion to 11.6 billion. And then market cap, again, shares outstanding times market price, and an enterprise value, 14 billion to 38 billion. One quick pause here. Enterprise value, that's what we look at. We're not interested so much as market cap. We want enterprise value because enterprise value takes all debt and all equity as one cohesive enterprise and says, okay, value that enterprise as a whole as if we were to buy everything lock, stock, and barrel. It matters how much debt a company has on, and looking purely at market cap excludes any debt that they have on their balance sheet. So, brief pause on enterprise value. Thanks for following me. That's the that's the Royal Caribbean. This is Carnival Cruise. EBITDA, as we said, growth, a little slower on the growth, 5.4%. Debt load, don't ignore this number here for a second. This is 11.5 billion. Can't talk this morning. And that is at the end of 2019. So I'm filming this in end of Q1 2020. Things have changed, but as fiscal year end, that's what they have. So that's what we're going with right now. Market cap 30 billion and enterprise value. Enterprise value really didn't move a whole lot, 35 to 42. This is 14 to 38. That's surprising. So this one actually, the enterprise value is growing. That could be because they're taking on more debt. So if you're adding debt and equity, this number is growing, but you're doing it because you're just borrowing more from the bank. This is a little bit more stable. Now let's get to the fun part. Let's look at the debt load of each company. So we did revenue, check. We did earnings based on EBITDA, check. Let's look for our balance sheet smell check, and we will do debt load and market multiple together. So let's come back to, this is Royal Caribbean. Royal Caribbean enterprise value to EBITDA, that's what they trade in. It's the market multiple that they trade with. This is the range. So 8.7 times enterprise value EBITDA, all the way to 11.3, averaging 11.8. Enterprise value to EBITDA for this is a Carnival Cruise. Carnival Cruise 9.3 versus to a high of 12.8, averaging 10.7, averaging 11. So this one has a slightly higher. This is Royal. Royal has a slightly higher market multiple to it. And that could be because the EBITDA growth rate that we saw was a little higher. This is a little lower, but both very similar. Basically 12 and 11, so a 1 turn of EBITDA difference in enterprise value and the market multiple. Let's check the debt. I think this is going to be interesting. So here, this is Royal Caribbean. Royal Caribbean has averaged 4.3 times debt to EBITDA. That means for them to pay off all of their debt, it would take them 4 years, taking all EBITDA and chunking away at the debt. On the Carnival Cruise is 2.3 times, so almost half the debt load this is I'm getting my number. This is Royal Caribbean. This is Carnival Cruise. Carnival Cruise has half the debt. Now, this is very important. This one, revenue growth, earnings growth, half the debt is this one. While we're going into a kind of recession, going into difficult times, you want to make sure that balance sheet's there so you can weather whatever dip they have in revenue or earnings between now and when this thing is over. They need to have the war chest to be able to survive. That's going to be important. Let's keep going. So 4.3 times, 2.3 times, more levered, less levered, but they both have debt. Let's do this. Let's go to cash flow now. We're going to come up here for the Carnival Cruise, and I'll show you their cash flow, and then we'll look at Royal and their cash flow. You should be able to see that now. So cash flow from operating. Remember, this channel is for rational investing. We value companies on free cash flow. That's what we care about. I'm not interested, we are not interested in a 2-month move in the stock price or a bounce or any of the trading metrics that they use. That's not this channel, right? We are buying for the long term, we are buying for safety, and we're buying for cash flow. Let's take a look at this. Free cash flow, $1.5 billion at 2011, all the way to $3.7 billion of free cash flow operation. That's cash money that they generated from passengers getting on the cruise ship, buying their alcohol, booze, traveling around. That's doing that. What they have to do, what Carnival has to do after that, excuse me, this is Royal. What Royal Caribbean has to do after that is still pay debt service. They have to pay the bank because they borrowed money for the ships, and they have to buy new ships or put money into the existing ships to keep them up and running. Right? So that is a big cash expense, and it's not in cash flow from operations, and it's not in the EBITDA that we looked at earlier. So here we go. CapEx. Look at this. $1.1 billion in CapEx. That's very similar to the money that they generated. Free cash flow operations 3.7, $3 billion. So these numbers here are very similar, and that means that their operating cash flow that they generate is enough for them to maintain their ships and buy new ships, but not enough to really generate any money that's kicked out to shareholders. You with me? If I just look at these two as a whole, these are relatively close to one another every period, netting to almost zero. You've got your debt payments here. So if there's very little cash flow from these two, if I add these together, that means I have very little money to pay debt service, and then even after debt service, there's very little money to give to the shareholders, which is what we value companies on. So here you go, free cash flow to equity, negative in the first year, 2011, really low, $300 million. They got a pop here of $1.3 billion. You can see that's because they borrowed a lot of money. These two here are actually negative, so they generated $3.5 billion of cash flow from operations. They bought a bunch of ships of $3.6, $3.7 billion and upgraded. That's, call it zero. Then they borrowed $101.5 billion, and that's what this number comes from, and that's not really cash that we can rely on for permanent, sustainable valuation. So you get a pop, but you can see it reverts right back down the next year. So there's pretty thin cash flow here. Let's check, this would be Carnival Cruises. So here, $3.7 billion, CapEx, very close, but actually a little less. That's about $1 billion of extra free cash flow here. That year they happened to have no debt payments. They did some refinancing, so you can see you got the free cash flow of $1 billion. Moving through, you've got roughly 2 to 5. It's tough to see in the glare. I'm going to switch to over here. But every year, if you're looking at this on average, this is, let's see if this works. That's $2.7 billion average, and this is $4.2 billion. I'm excluding this last year for a second, bear with me. But on average, cash flow here is $4.2 billion. CapEx here is $2.7 billion. So that's about $1.2, $1.4 billion of cash flow that they generate after buying ships and after reinvesting. So there's more free cash flow here than there is here before debt service. Look at debt service, and then a lot of it is borrowing, right? They're borrowing a lot of this free cash flow is borrowing, but at least there's something between these two numbers. They make some cash flow, about $1 billion, from operating their vessels and reinvesting in their business. That's good. That means there's enough cash for debt service, there's enough cash to kick out, which is what we value. Here's the share count. Let's move forward to zip this review along. How do I frame this? There's the yield, there's the growth rate, shares, yield, growth rate. There you go, perfect. So let's look at free cash flow per share. For this is a Royal Caribbean, negative 5 cents, 8 cents. It grew nicely, again, largely because of the debt they borrowed. Average growth rate 1.3. Even with the debt, their growth rate is very small. Here, this is Carnival Cruise. Free cash flow per share, $1.50, 80 cents, 3, 3, 3, 3, 4. I mean that's good, and it's giving you a bigger growth rate of that's the growth rate. That is the yield. 4.2%. This is the yield, 1.3%. What am I doing? I'm taking free cash flow per share, dividing it by the price per share to get a yield, just to be clear. So this is yielding less, mainly because the operating activity of the business that generates cash isn't enough to cover the purchase of ships and the reinvestment. And a lot of this yield comes from borrowing. That's why they have higher debt that you saw earlier. These guys produce some free cash flow. They're able to profitably operate their business, generate cash after reinvestment, and you're seeing that reflected in the yield. Okay, so what do we know? We've got revenue growth, check. Top line revenue growth, check. Free cash flow is weak here, I would call it. I like to see the 4, 5, 6%. I mean, this is better than this, not stellar. And then on debt load, these guys have more debt than this. Okay, now what? Let's see what do we do with this. Let's update things for the current fiscal issues, right? Demand is way down. We know if we think of forwarding these numbers in the future, they're not going to look like this. This is during the longest bull market in the history of the economy, a 10-year economic cycle. These guys, even during that time, did not generate a whole lot of free cash flow. These guys delivered a moderate amount of cash flow. So what we're going to do first is let's look at, this would be Carnival Cruise. Let's look at Carnival Cruise, and we're going to update for the most recent information. So if you read the press, what you're going to find is that on April 1st, thereabouts, I think that's when I read it, Carnival Cruise issued a new bond, a new debt for $4 billion. And that bond issuance is at an interest rate of 11.5%. It's due in 2023. So it's a lot of money. It's due fairly close, within 3 years, 4 years if you count 2020 through the end of 2023. In addition to that, they raised $500 million in equity. They sold the equity at $8 a share, which at the time they did it was a 30% haircut to the market price of Carnival Cruise. And that diluted out there 62 million shares. And so now the price of Carnival has come down roughly in line with the $8 that they sold these new shares at. Why is this important? Because if we're looking at a business that Carnival had less debt on it, well, they now just put $4 billion onto the balance sheet. That's what I'm doing here. I'm just saying I started last year in 2019. I ended last year in 2019. 11 billion. I add the 4. I get roughly 15.5 billion dollars of debt. That debt needs to be paid down, right? If they have historically been in a roughly 2 times debt to EBITDA ratio, and that is something that's sustainable for their business, and they've borrowed money, this multiple here, 15 times last year's EBITDA is 3 times. They got to buy that down. So what I've done is I've purely guessed at what next year's EBITDA is going to be for Carnival, and all I did was just take current year EBITDA and cut it by 50%. That could be rosy, but to put a number out there, and for illustration purposes, I halved it. So that $2.6 billion is what the EBITDA could be in 2020. If the debt load for the company needs to be 2 times, remember they averaged 2 times EBITDA historically, well now their EBITDA is less. That means they have to buy down a lot of debt. That means they can only have $5.3 billion of debt to be 2 times EBITDA. Well, they're currently at 15.5. That means this company, in order to get back to financial prudence, the way we look at it, has to pay down debt in the tune of $10 billion. And because the new money came in with a maturity date of 2023, I'm saying they have 4 years to get there. And if you're the investor buying the bond in this company, you know, you're in the pension fund, whomever has the $4 billion of jack and saying, okay, Carnival, here's your money, you're going to want them to be de-levering as you go into the next 4 years. And you're going to say, what do you think your EBITDA is going to be at the time of maturity? And I want you to buy me down during that period of time. Oh, by the way, you still owe me 11% coupon, but I want you to lower the risk of the company, buy down the debt over time. So I'm saying you got to reduce the debt to normalize the business by $10 billion, 4 years. That's $2.5 billion of debt payments they got to come out with every single year in order to buy this debt load down into normalization. You with me? So all we're doing is saying we're going to be lower as a business in 2020, and then I'm using 2023 here because the bond is due in 2023, and I'm going to say that you're not only going to be lower next year, but I don't know where the Carnival business, or excuse me, where the cruise business is going to go. So I'm going to say you're going to be 50% of earnings between now and at least 4 years when this bond matures, to give me some cushion as if I'm the bond buyer, if I'm investing in here. So if you're half the size you were now, if you're half the size in the future, that means you have less cash flow. You have less cash flow to pay debt service. I need to be careful of that. I need to get my money back. So you're going to make a $2.5 billion investment, a payment every year. Let's look at free cash flow and see, can they afford this? What does that look like? So that's what I have blacked out here. I'm saying current 2020, and then 2024 when that note matures. Ballpark, what could they look like? Free cash flow of operations. I've halved the EBITDA. And I went and said, if you're going to be half the EBITDA here, if I took this number, just said cut it in half, that's a little less than this number. You're more in this range, right, 2.9. And I said in 2013, what was the free cash flow? 2013 free cash flow is roughly 2.8 when you're smaller company, smaller free cash flow. And now I'm saying, okay, free cash flow 2.5. Is it right? Probably not. Could it be more dramatic? Yeah. But we got 4 years to be there, so I'm saying they're going to be in that range for between now and the 4 years when the bond is matured, because the business is permanently changed. The environment is different, and I'm not gambling that it's going to come back as fast as we think it might. CapEx, again, they're not buying any new ships. We know that for sure. Their principal job is to pay back that loan, operate the business to pay back and squeeze a little cash out. So I haircut their CapEx to just maintain what they have at a very, very meager rate. That's not much money. Debt payment, that's again the debt payment we just calculated, $2.5 billion. That means free cash flow for next year is negative. And in fact, I think free cash flow is going to be negative between now and when that bond is paid off of $4.6 million. And then here's your dilution. Your dilution is the difference between these shares. So you can see the share, free cash flow per share went from 212 to negative 61 cents. That's after debt service and after the dilution of issuing out a whole lot more shares. So where are we right now? This is kind of the patterning of cash flow between 2020 and when they pay off the note in 2023. And you can see that over here in our forecast. So I'm saying, I'm picking up the free cash flow in 2020, I'm saying it's going to be negative. Debt service, halved business, plus CapEx, easily sucking cash, and we're going to have to make sure they have enough cash on hand to be able to afford that burn. Or they have to raise more equity, which is more dilution. And then, when the business is paid off, when they get the business back to 2 times debt service, like we said earlier, and that payment falls off, then that's free cash flow that can go to the equity holders. Right? If I'm making $2.5 billion in debt service payment now for 4 years, and in 4 years that's paid off, I still generate the $2.5 billion. Now that goes to the equity holders. With the dilution in shares, that's about 85 cents. I grew it just at 3%. In year, I get 99 cents or $1 per share of free cash flow in 2029. I applied the yield that we saw earlier, about 4.3%, I think it was, and I get a share price of $23. Yeah, yield was 4.2. And I get a share price in the future of $23.51. All right, let's see. This here is the calculation of how I got that. I'm saying, again, free cash flow is a little higher with the EBITDA. I step up the CapEx because they have deferred maintenance. They'll have to pick up money for there. I've got a little bit of debt payment left because I'm not debt free, but I have some debt. Free cash flow is positive at that point. Shares outstanding still diluted, and I get the 85 cents that you saw earlier. That's how I did it. Simple. Is it right? Is it wrong? I don't know. But there's some numbers out there that are decent with enough time. We'll see what that does to the IRR of this investment. Let us before we go to let's go to Royal. All right. Let's finish Carnival. So then I showed you the price per share here, $23 for Carnival. Let's go down and look at EBITDA forecast. EBITDA was the same thing. I followed the same pattern, right? I told you I haircut EBITDA 50%. That's the 50% mark. And then I basically held that flat as they struggled to make debt service, to eke out a little existence, being half the size that they are. And then in the future, when that debt payment's off, the market recovers a little bit 4 years from now, and I basically kept them at half the size they are right now for the 10-year with a little inflation. And they get to 3.1 billion of EBITDA, and that's less than the 5.5 they had before. So I'm saying even after all is said and done, the economy covers 10 years from now, I'm saying Carnival Cruise Line is going to be half the size they once were. What does that do? Enterprise value, debt, the diluted shares, right? That 500 million with the 62 million more shares issued, tacked onto what they had, gets you 750 million shares outstanding at $25 price target. If I weight average these on each, you get an average $24 a share price in 10 years. As of yesterday, it was $8.50 in the public market. Let's look at an IRR here. 2020 free cash flow still negative, remember, still negative. Buy-in at $8.50, I've got another stream of equity. They need to be able to fund that with cash, which they might be able to. I looked at their cash on hand on the balance sheet of the 10K. At the end of 2019, they had $500 million in cash. They just took on another $500 million. They got about $1 billion in cash. They could probably raise a little bit more debt if they had to, maybe. So I'm saying that they can afford that. But then it turns positive in the outer years as they pay down the debt. You kind of return to normal, and that normal is half the size they once were. Go to $24 stock price in the exit. I get an IRR of 13%. The IRR is the annualized return you're going to get if you bought the stock now and this happened and you exited at $25. That's the discounted cash flow. The IRR is the representation of that in an interest rate, a return rate. That's roughly 3.2 times your money. Before we dig any further, let's go compare Royal Caribbean. We were here, if you recall, Royal Caribbean. Let's look at what they have coming down the road. I'll zip down to their debt load here. And what I thought was really, remember, I'll recap. Sorry, I'm skipping around. Let's recap. Debt load was high for Royal Caribbean. It was already high going into the decline. They had on their balance sheet $11.6 billion of debt. When I read their 10K, page 183 gives you debt payments that are coming due. And what you'll notice very, very clearly is this year, 2020, they owe in cash money to the bank $2.6 billion in debt service. If we go to our free cash flow for a minute, end of 19, they didn't make anything, right? We were saying the difference between CapEx, buying ships, and operating cash flow was roughly zero. They're dependent on borrowing money to get cash flow. Well, if the credit markets, like we're seeing, are slowing down and banks are becoming more conservative, I think the odds of them reaching into the debt market to finance their operation is limited because they're already levered, and they owe the bank, or a bank, $2.6 billion this year. How much cash do they have on hand? They have $250 million of cash on hand. That's half what these guys have. And they owe, that's roughly 10 times to the bank what they have in cash, right? They owe 2.6 billion. They have 240 million. That's a big difference. And then if you look into the future, the following year, a little less, $830 million, and 2022, 1.5 billion roughly. Now why am I looking out in the future? Because if our thesis is things are going to return to normal in the future, and I'm just saying that normal for the cruise industry is going to be half what it once was. That's more of just a hedge for us to protect the equity investor. I'm not giving them credit that it's going to return to normal. I'm saying it's going to return to half. So if it returns to half 5, 6, 10 years from now, but in the short term, the 1 year, 2 and 3 year, these guys have to weather a storm and uncertainty. I want to know how much cash they have, what's due. And what's due in the next 3 years is almost $5 billion. I don't think you can't see that, but $5 billion of debt is due. So what I'm doing down here is I'm saying, okay, they don't have the cash on hand. Revenue is going to be down. The debt market is going to be very difficult to raise money. I think the fact that Carnival was able to get a debt deal done speaks volumes to the markets favoring one or the other, and kudos for them to getting it done so quickly. Even at 11%, that kind of jack is hard to come by right now. So I think the market's kind of chosen for us which they're backing, Carnival versus Royal. Royal then needs to, its current debt is $11 billion. If I said, and I didn't cover this in the last round, but when they had roughly $15 billion of debt, if you looked at forward EBITDA was, I think, 3 or 2.5. Well, 15 divided by 2.5 is roughly 6 times. So their forward debt leverage is 6 times. I'm using that here because the public market in Carnival had already signed off on the debt. Right? They borrowed. Let me just go to it. They borrowed the $4 billion. They borrowed the $4 billion. You got $15 billion in debt. I'm saying next year's EBITDA is going to be 2.5. That's 6 times leverage. Okay, so if that deal got done in the public market, that means someone's willing to put money in it. I think it's a rational assumption then to use 6 times as a maximum amount of debt that these guys can have. And what you'll see is they have 11. Max with the forward EBITDA of being half this is only 10. So they're already over levered going into this decline. That means they have to buy down today $1.5 billion worth of debt. Then you look at what's coming due. If I'm an equity investor and someone comes to me and says, hey, I need $1.5 billion right now or I go to business, you're going to say, okay, what comes due after I give you that money? What's next? If I put in a check today, what do I have to put in tomorrow to protect the money I just put in? So you're going to say, oh, well, I've got another, this was $5 billion, I think we said. Yeah, it's 4.9. $5 billion. I need to cut my debt down by 1.4, so that's what, 3.5 billion net of what's coming due after I give my initial investment in. So I'm saying here that I'm going to have to reserve, or if I'm going to go to the capital markets and get equity, the equity investor is not only going to want to cover this, but put in enough money to cover a couple debt payments in the future to make sure you have runway to last, to get through the downturn if it takes longer. And that means another $2 billion of cash just for debt. That's just buying down debt. Then to operate, you need to pay workers, you need to pay vendors, you need to put a little money into your ships to make sure they work. Forget buying new ships. It's just keeping the paint up, lights on, all kinds of those infrastructures. I said another $1 billion just for wiggle. So I need to raise $4.5 billion right now for this business. What does that mean? Well, they're currently trading at $24. All right, so they're currently trading at $24. I'm having that. Why? Because Carnival Cruise raised money at a 30% haircut to public market. They're first out of the gate. These guys are more levered and now have to find another big investor willing to cut a check that's interested in the cruise line business. That could be fewer people, right? So I'm saying in order to get that done, that investor is going to have to come in at a bigger discount to market. So I'm saying 50% of the stock price that's currently traded, that's what they're buying at. If I raise $4.4 billion at a share price of $12.26, that's 365 million shares they have to issue to raise that kind of jack. What do they have right now outstanding? 209 shares. That's 150% new shares coming out into the world. What is that going to do? That's a lot. I mean, you got to think from an equity investor perspective. They can buy in now, or they can say, "Look, you're on the ropes. Why get in and take all the baggage? Why not sit back, let the thing crater, and then go to the judge and say, I'll buy the shares for less than $12, pennies on the dollar." So be careful. I think this is a big risk that someone will even think of doing this. But if they did it, that's kind of where they would go. What does that do for valuation? So let's zip down. We're going to go through the free cash flow method. So, and this is a complete guess, right? I don't even think they can get the equity deal done. But if they did, they would barely have enough money to cover their payments. Right? So here's 2020, free cash flow operations I have, like we did before with Carnival. $500 million in CapEx, like I did with Carnival. Debt payment, they got to pay this debt service down. That's what's looming. If for some reason they raise the equity, I guess this would come down. But I don't know. Right? So I'm basically saying that they're going to lose money. That's what this is. That's what the equity investor is going to come in. But I can't forecast that. I have no idea if someone's going to cut a $4 billion equity check, so why would I buy the stock now? So because I don't know, I'm just zeroing out. I have no idea. But I'm saying by some miracle they come back online in the future with the dilution that you're going to have to get with those equity guys. It's about 20 cents a share. That gives me roughly $14 a share. On the EBITDA side, I've got, again, halved EBITDA, growth for 3% with inflation because I think the market's just going to be smaller. There's your new share count outstanding. That is the 200 million of existing plus the 350, 370 of new equity. I get a $26 price on the forward price. So you're trading at 24 now. I think you're going to be in the 14 to 26% range after dilution. So I think there's not much there. If you look at the IRR perspective, I'm at a -1. All right, so let's say this is wrong. Let's say they revert back to normal. You get all the EBITDA back that they lost. Let's see what the range here is. What's the upside? So if I take this EBITDA right here at 2029, and instead of being $2 billion, sorry, I'm blocking it. Instead of being $2 billion, I'm going to say they fully recover, and they get back to, they being Royal Caribbean, gets back to their 3.4 that they had before. What does that do after dilution, after the equity guys come in, the whole thing? That's a $46 price tag. All right, let's go here. We'll set this to 100%. So I'm now leaning only on this $46 price target. So I've upped the price target from our original forecast, almost doubling it. What does that do for IRR? So now I buy it at 24 bucks. There's massive dilution, and then the share price collapses. And then over the next 10 years, the business grows back to what it once was. That gives me a share price of 48 bucks. That's 8% IRR or 2 times cash. I'm not seeing it. I don't see how an equity investor, is going to put cash in here for that $4.4 billion that these guys need, because the economics don't really smell check. On the other side, for a future value and for Carnival, you've got a, let me find it, 13% IRR if they are kind of half what they were historically. Let's go here and we're going to make Carnival what it once was last year, $5.4 billion. That's a $43 future price tag. I'll put the model so it's 100% relying on the 43% target as an upside case. What does that mean? That means a 20% IRR or 5.4 times your money. Okay, we just went through a whole lot of math, right? This is a math exercise. There's no guarantee of any of this. On the base case where the business is halved, or I'll say the upside case where the business returns to normal, you're at a 20% IRR here, you're at an 8% IRR here. If for some reason that does not happen and the business is back to what it, half, then Carnival is at a 13%. I got a bad lag. Does that fix it? No. If it returns to normal, then Carnival's at a 13%. So your base is like 13% IRR. Best case is 20%. That's okay, but I think the downside here is either of these companies go out of business, in which case your money is zero. So you're betting that you're going to make maybe 13 to 20% or zero and lose everything. That's your risk in return. And there are other investments out there in the stock market right now that are paying 15, 16% IRRs where they have much less debt, where they're not at risk of going bankrupt. So here, the IRR on the Carnival cruise, to me, doesn't warrant the risk of losing everything. Let's look at Royal. So Royal, again, if we reset what we once were, we were at an IRR of -1% or positive 8% with someone injecting $4 billion of cash. I think the $4 billion of cash is highly unlikely to come in, because even if it does come in, your IRR is 8%. That doesn't justify that kind of jack coming into the business. And I think these guys are at extreme risk of going bankrupt. And then, so I think I think both these companies are risky. I would have to say, if I had to give a number to or a value or a ranking to the Carnival, I'd give it a bad investment, right? Because I think, given the risk of bankruptcy here and the upside case of 20%, that doesn't smell check. There's better risk-return reward ratios in the market than that. For Royal, it's got to be ugly. These guys will, I think, have a high degree of risk of going bankrupt, and you don't want to be anywhere near that. They're fully leveraged, so that means that if they were to go bankrupt, there's a long line of vendors, lenders, vendors, employees, everyone in front of you in the court system when you're arguing for your money, and there's going to be nothing left for you as an equity holder. So I'd be very cautious that the market's going to let Royal go bankrupt, and then an investor would come in at that point after everything's been haircut and buy the company. Carnival could survive. I think the best thing for Carnival is actually if Royal goes bankrupt. That means that there's the customers that are still willing to travel in a cruise ship would migrate somewhat to these guys, and they would lift their revenue, lift their customer base, and they would be able to pay off their debt. So to conclude here, what are the 5 things that we look for at rational investing, right? Revenue growth, earnings growth, free cash flow, solid balance sheet, and well priced. Royal Caribbean, revenue growth, earnings growth, but very questionable going forward. Free cash flow is not there even historically. Balance sheet is highly levered even historically. Well priced, no it's not. So I think Royal is not only past, is dangerous. Carnival Cruise, top line revenue was growing, earnings were growing. Going into the future, we think it's going to shrink. Then you've got a balance sheet which was decent, and you've got a price which is decent. But I think there's safer ways to make money in the future in the market rather than gambling that these guys are not going to go out of business. So that's a summary of what I think of for the Carnival Cruise and Royal Caribbean businesses. I think it's very interesting. And there's a lot of people that have pinged me about the price is down, doesn't that mean it's a good value? And I think this shows that the price is down for a legitimate reason. The market's calling this correctly. And the people who put money into Carnival did some research. They knew that they were not under-levered, but could afford a little bit more leverage, and it's already been there. So if you buy now, you're behind the people who put the money into Carnival. If they should go bankrupt, you're at the very end of the line before the judge trying to peek over everyone to see what's going on. That's going to be a hard time. There's a lot of risk there. So your risk is you make 0. Your upside is you make 20%. Your base case would be you make 13%. I think there are safer ways to make money. And this channel is about protection of principal first and foremost. Remember, you need return of capital before you can get return on capital. So I think it's going to be a hard pass for us at Rational Investing on either of these two. But I look forward to your comments. Thank you very much for coming, for watching the views and for giving me questions. I love taking the questions. Please subscribe. Send me questions, send me recommendations of what you'd like to see. My name is Cameron Stewart, CFA with Rational Investing. Thank you very much for your time. Take care.